This video is going to be a training on how to present critical period coverage, or we also call it mortgage payment protection. So this is going to be the presentation that if somebody is a little bit older, maybe over 65, or they have some health issues, and they're either not going to qualify or it's just going to be probably too expensive to do a full mortgage payoff. So we're going to cover maybe a year, year and a half, 2 years of mortgage payments with the mortgage payment protection option. So I'm not going to go into the entire presentation as far as building rapport. We'll do other videos on that, or the qualification form. But where I'm going to start this off is going to be assuming that you've already built rapport, you've already gone through the qualification form, verified the information, verified the loan amount. You want to make sure that you get the home value so that we can look at how much equity is in the house. You want to know how much the mortgage payment is, and you also want to get the why. And I'm assuming that at this point you've already done that in the presentation. We already know that what life would look like for each of them if one of them were to pass away. We kind of know generally what the income might be. I'm going to ask questions like, how much Social Security you guys going to be making, or do you make currently? How much income loss is there going to be if he dies or if she dies? So let's do a little role playing and assume that we're meeting with John and Mary. Okay, John, let's just say he's 69 years old. Mary is 67 years old. They have a little bit of health issues, and we're going to say that they have a mortgage of $100,000. Okay, that's the mortgage amount. So I'm gonna say, okay, John and Mary, let me explain my role. I'm what they call a field underwriter. I work with about 36 different insurance companies that offer mortgage protection, and based on what you guys have told me about your health, your situation, what you're wanting to do, why this is something that would be important for you guys to have, I'm gonna make a recommendation for you guys. But before I do that, I want to go over a couple options, okay, just so you know what they are. The first option you're probably familiar with. Let me just get the screen right there. First option you're probably familiar with is the full mortgage payoff option. Let me erase that. Okay, so first option, full mortgage payoff. Okay, now that, John and Mary, that's exactly what it sounds like. That's the one you guys are probably thinking about, where if one of you passes away, the entire mortgage gets paid off. Okay, that's option one. Option two is mortgage payment protection. Okay, now I would say 90% of people that are over 65 or have some medical issues, a little bit below average health, are going to go with this second option. Okay, for three reasons. First reason, it's the most affordable. Nobody wants to be insurance poor during retirement, right? So it's got to fit in the budget, it's got to be comfortable. Second reason, most people go with this option is because it's the easiest to qualify for. You don't have to do blood work, you don't have to do a urine test. This is a very simple application process, and a lot of people like that idea. Third reason that most people go with the second option here is because it's still going to do what you guys are wanting to do, which is protect each other, make sure that you guys don't lose the home if something were to happen to you. Okay, so let me share a story with you of how this second option works. Okay, now notice I'm not explaining the details and the facts. I'm going to share a story and let the story do that. So my brother Matt, and that's how I share the story, my brother Matt sat down with somebody not too long ago, a lady, and she filled out a form just like you guys did. And he asked her, why did you fill this out? What prompted you to fill this form out? And she said, well, my husband's already passed away. My son is 27 years old. He's mentally handicapped. And what made me think I need to look into this is because the lady across the street, her husband just passed away 3 months ago, and there's a foreclosure sign in the yard right now. 6 months ago, my next door neighbor's husband passed away and her house foreclosed on. And 2 years ago, another lady's husband down the street also passed away, and she lost her home. Now, I don't know about you, but can you imagine losing your spouse, and on top of that, a few months later, losing your home, and along with that, you lose your dignity, you lose your credit, so now it's going to be very hard to find another house. You lose your equity, because all of these three women had some equity in the house. I don't know if it was 10,000, 50,000, or 100,000, but all of them had equity in the house. And as you guys know, if the bank forecloses, who gets that equity? The bank does. So let me explain how this protection would keep that from happening. Okay, let's just say your house is worth 100,000, or that's what the loan amount is. Okay, now what do you guys think it's worth? And John says, well, we just had it appraised, and it appraised for 130,000. Okay, so we've got $30,000 of equity in the house, right? But I tell John and Mary, I say, okay, we can't look at the situation in today's numbers, because you're not likely going to pass away tomorrow. You guys are in pretty good health, right? So let's just give a realistic picture here, and let's just say, John, now hopefully this happens, but I'm going to pick on you because I don't like to pick on the ladies. So John, God forbid, let's say you pass away in 15 years, okay? That $130,000 home value is going to be worth a lot more. Now, I don't know about every area in the country, but I know in my area, home values appreciate at 4 to 5% per year. So that just about makes the homes double every 15 years. So, John, let's just say it doesn't quite double. It doesn't go to 260, but let's say that the home value goes to maybe 230. Does that sound realistic? He's going to say yes. 100,000, you're not going to owe 100,000 in 15 years, right? You might owe 60 to 70, let's just say probably 60 in 15 years. So now we've got an equity of $170,000. So if the bank takes it over, the bank forecloses, that's what they're going to get that much profit, and that's what Mary's going to lose out on. So we want to make sure that we protect that, so that goes to Mary. So here's how this mortgage protection payment, the payment protection works. You pass away, John, and they step in and start paying the mortgage for a certain amount of time. Now you guys set that amount of time, however much time you feel like is a good amount of time. The longer you go, the more it costs. So we want to find something that fits in the budget, that still is a nice safe number. But this is going to give Mary time, or John if Mary passes away first, number one, to grieve properly. Nobody wants to have to be worrying about the bills and the mortgage at the funeral. Let the dust settle. It might take 6 months just to get through some things. You don't want to have to go through all your stuff and try to figure out how to fire sell your house in the middle of a loss like that. So we want to have plenty of time to grieve properly, not have to worry about anything. When the time is right, then you can start putting together a plan. You may decide, Mary, that, you know what, $60,000, keep moving the screen here. You may decide that $60,000 you could refinance that. And instead of, currently you're paying, let's just say it's $700 a month, you may be able to refinance and get that payment to $400 a month. And you may say, you know what, at that point, I could afford $400 a month, and I'd rather stay here because I've got a lot of memories and I don't want to have to sell the house. But you may also decide, you know what, the house, it's a little much, it's a little big, I don't really need this much of a house, and I'd rather sell it and not have to take the first offer, but be able to take the right offer. And I can tell you guys from my personal experience, my mom's parents passed away. My mom's mom was the last one to pass away. And when she passed, there was a mortgage on that house, and there was a lot of equity. And they ended up moving into my grandparents' house because it was a nice house, and selling their house. But the problem was they couldn't afford two mortgages. And even though they made pretty good money, they didn't want to have to pay an extra couple $1,000s in a mortgage payment. So unfortunately, their first offer that they got on their house was for $90,000 less. It was actually exactly what they owed, and it was $90,000 less than what it was worth. And it was an investor. And that's what happens a lot of times when people pass away. These investors, they know that that's the case, and so they'll offer you what you owe on it. And my parents' first thought was, what if this is the only offer we get in the next year? Do we want to pay an extra couple $1,000s a month hoping to get a better offer? And so they sold it and lost out on $90,000 of equity because they didn't have a year's payment. So in this scenario, you wouldn't have that pressure. If you have a year, year and a half, 2 years with a mortgage is paid for, I know my parents would not have taken that first offer. They would have not had the pressure to have to sell it fast. They would have been able to leave it on the market and wait for the right offer, and that would have meant an extra $90,000 in their case. So if that's what you want to do, Mary, you could take this $170,000 and possibly go pay cash for another house, or have a good down payment, or you may decide at that point you'd rather just stay in an apartment and keep that $170,000 in the bank. But the point is, none of those decisions have to be made right now. The point is that it's going to give you options. So when the time is right and you are in that situation, you've got plenty of time. You're not backed up against a wall and forced to make a bad decision. Does that make sense to you guys? And I'm going to wait for them to respond. Does that kind of coverage make sense to you guys? And they always say yes. They always say yes. It does. Okay, so as soon as they say yes, that makes sense. I'm going to transition now into going over the options. Okay, does that kind of coverage make sense to you guys? Yes. Okay, great. Then what I want to do is go over some options that that'll give you enough time, but also are going to fit in the budget. How much time, John and Mary, do you feel like would be a good, safe amount of time? I like using that word, safe amount of time, because it makes them err on the side of caution and pick a little bit more time than they might, just to make sure that they've got enough time to sell or refinance if they need to. How much time, John and Mary, do you feel like is a good, safe amount of time to give each other? And they've never thought about this. They might say that. We never thought about that before. And I'll say, well, let's think about it. What do you think you would need to, you're probably going to need a good 6 months to grieve. After that, you may decide to put it on the market. What do you think? Year, year and a half, 2 years? And they might say, yeah, I think a year's enough. They may say 2 years. I'm going to try to give them a year, year and a half, and 2 years, but I want them to be actively participating in this presentation. I don't want to just say, let me show you your year and a half and 2 years, because they may not be on the same page. If they tell me in advance, I think a year would be enough time, then they can't tell me later, I don't think a year's enough time. If I don't have them participate, though, then they may give me that objection. I don't think a year, year and a half is enough time. Okay, so if they say a year and a half, okay, great. Let's look at a year, 1 year, year and a half, and 2 years, just so we have some different numbers to look at. And I say, okay, that sounds good. And I'm going to do John separate and Mary. Okay, John again is 69. Mary is 67. Okay, now depending on the company, let's just say they're going to be UHL Premier. But you're going to get with your mentor beforehand and know which products you're going to offer them. But a year for John, maybe, let's just say, just to give us some simple figures, 150 or 50, 75, and 100. It might be double that. I don't know. And the way I'm figuring that year, again, is $700 is their monthly mortgage payment times 12 gives us, $8,400. That would be a year's worth of mortgage payments. So when I go into my UHL calculator to figure out the quote, I'm putting in $8,400. I'm not talking about $8,400 to John and Mary. I'm talking about a year. I'm talking about a year and a half, and I'm talking about 2 years. The reason is because people don't buy this for what it is. They buy it for what it does. And there's a big difference in what it is and what it does. What it does is cover the mortgage for a year. $8,400 doesn't sound like a lot. Okay, but again, what we're doing with the 8,400 is protecting the 170,000. Okay, so I want to make sure that that's what I'm talking about. So I'm putting 8,400, and that gives us that. And maybe Mary is 45. You know, this would be 90, and let's just say this is 68 or something like that. Okay, so then I'm going to say, okay, what do you guys here's the rates. 1 year is 50 and 45. Now you don't have to pick the same number for both of you guys. If Mary is going to be worse off without John, we may want to give her some extra time. We may want to do 2 years on John and 1 year or a year and a half on Mary. That's fine. Okay, so I'm going to say, what do you guys feel like is a good, safe number, but also fits comfortably in the budget? And I just stop talking at that point. I don't talk anymore. Even if I have to sit there for a minute in dead silence, I want them to answer my question. Which number here do you feel like gives you a nice, safe amount of time, but also comfortably fits in the budget? And they may say, you know what, I think a year and a half is plenty of time, and I think we can afford that. That's comfortable. So I'm going to say, okay, so we're looking at about 143 a month for both of you. Is that comfortable? Now you may be asking, why am I making it so blatantly out? They just said, why don't we just go ahead and do it? I want to make sure this doesn't get canceled later. I don't want them in a month or in 2 weeks or in a week when this drafts for them to add it up and say, man, this is a lot more than I thought it was. Let's cancel it. I want to make them tell me, yeah, 143, that fits. When they do that, I'm going to circle it. This solidifies the decision. Okay? Once they do that, I am moving immediately to the application. I've got it on the table already. I'm starting to fill it out. I'm not getting permission. They already gave me permission. They said this number fits, it's comfortable, it will work. Now we're going to apply for the coverage, and I start, and I got this from my brother Matt, but I start with the beneficiary because that's, again, why they're doing this. Okay, so John, we're going to put Mary down as your beneficiary, and then I go back up to the app, start writing in the address, the phone number, I get the social, and go on through the app. Okay, so that's how I present critical period coverage.